Stephen Koukoulas from Market Economics here in the studio. Thanks for your time. It's kind of interesting where we're on the income tax cuts. I mean, the government had a mandate for not much. You'd think this were it. And, I mean, there's a good point made over the weekend when you look at $180,000 as, you know, the top bracket, how much of the tax cuts going on this. It's also a bracket that hasn't shifted at all for many, many years. And if you'd had a wages index to this, the top bracket had actually started at $280,000.
Yeah. Look, I think that it's fairly clear what the coalition took to the election. As you said, it wasn't a huge policy agenda, but the income tax cuts were the vast bulk of it, if not all the important economic issues were located on their tax policy. So, in a sense, they've got the mandate, and Labor, I can understand they want the details. I think that's important to see where the tax distribution goes, both in tranches 1 and 2, but also in tranche 3. That said, I think Labor could create a political problem for them if they only agree to the first 2 tranches, because you'll get right through the next 3 years and up till election day in 2022 that they'll say, look, Labor's against income tax cuts. So it's a political problem. The economics, well, that'll work itself out in a few years' time.
So when you talk about, you know, it's important to get the detail, we know the detail is going to say that most of the money towards those later, you know, tranche 3 goes to high-income earners because of the nature of the tax system, right? I mean, they know the answer they're getting.
That's right. Well, they know the answer within broad figures. That's right. So we know roughly what it's going to be. It's going to be many tens of billions of dollars, I should say, of the cost to the budget over that medium term. So we know that based on current projections. And if the economy muddles along and then recovers into the next year, then the budget numbers will be sort of okay. The iron ore price is delivering an absolute mozza of revenue to the budget at the moment. So the budget numbers are looking about where they were at PFO time. And the tax cuts, well, they're simple, straightforward economic issue, and the politics probably go against Labor if they block them.
Yeah, the sort of question to answer strikes me a bit like a barristerial question in cross-examination. You know the answer you're expecting, essentially. I want to talk the RBA. I know you've had a decent crack at them for basically being asleep at the wheel. Interesting, we've finally had this cut, and I've seen that plenty of people are factoring in now, going all the way down to 0.5%. And
it's almost where the futures market is too. So it's not only just the big forecasters, you know, the Bill Evanses of Westpac and Sally Auld from JP Morgan, who are, of course, some of the best monetary policy viewers in Australia, but the market's now pricing it in, partly because of our own domestic economic conditions. Of course, the economy is subdued, inflation's low, unemployment's starting to creep back up right now. But also, as we saw late last week, as we'll see on Thursday morning our time, the US Federal Reserve could well be moving to an easing and a rate-cutting bias. So
how does that affect us then?
Yeah, look, it's just the global economy is subdued.
Yeah.
So if the US is going to be cutting rates from a peak of 2.5%, and say this time next year they've cut to, say, 1.5%, then that's a sign that the US economy has lost some of its momentum. We know that China's easing policy at the moment. So the global economy is quite fragile. I won't say it's bad, but it's fragile, and we're caught up in that.
And the cut for the US, does that hit the sort of stimulus for exporters that we hope with getting our own cuts as well?
Well, that's the dilemma on the currency at the moment. One of the reasons why the interest rate cut scenario was so good for Australia, one of the stimulus effects of the rate cut would be through a lower Aussie dollar. And this morning we're about 68.5 cents. If the US does in fact follow through and they cut rates, and probably cut them more than we do over the next 6 months, then perhaps the Aussie dollar doesn't fall as much as we previously thought. So there's that trade-off that occurs, whether the Aussie dollar falls to, say, 65, gives our exporters a real boost and sort of underpins a better 2020 for the economy.
Might mean that people holiday in Queensland instead of Bali as well.
Indeed.
House prices, now they might just be bottoming out. The issue is there's not a lot of stock on the market right now. So the higher clearance rates, driven, we assume, as well in part by, you know, the election and none of the Labor changes coming to the market. Do you think this is, we've got a real proper bottom in the market, albeit I know there's all these different markets within the Australian one? Look,
it appears to be the case that the evidence was starting to build, even before the election, the rate of price decline in housing was slowing. So instead of 1% per month, it was 0.5%. So it doesn't sound like a big difference, but there was actually something going on in the market, and even auction clearance rates pre-election were going up. Now, over the weekend, we saw auction clearance rates spike again, albeit on low volume. We do know that from the very good CoreLogic house price series, prices this month, here we are on the 16th, 17th of June, prices are basically flat in the month, so they're no longer falling. We know that rental vacancy rates outside Sydney are very low, so even the rental market's starting to tighten a little bit. So The dynamics for housing are, look, it'd be premature to say we're heading for a boom. No, we're not. The house price is not booming, but a bottoming in the second half of 2019 and even a mild recovery in 2020 certainly could be on the cards. And if the RBA deliver another rate cut or two, then the housing market and housing affordability gets a real shot.
Can I ask you very quickly on unemployment, because the RBA has been talking about structural reform, and I know your thoughts on the RBA perhaps, but you look at the unions, they had this change the rules campaign that was a flop. Do you think we're going to see much impetus for the other side, employer flexibility, if you like, to put it broadly?
Yeah, look, we have a pretty flexible labour market as it is. And in a funny way, the interesting issue is as the economy's slowed down, if we dissect the labour market numbers, the employment side of the economy has actually held up quite well. Job creation's still, chugging along at a decent clip. What's happening is that those people who have a job have been working fewer hours, which is what you want in a flexible labour market. So the case for more flexibility probably isn't that strong. What we do need to get unemployment down, people working longer hours if they so desire, getting underemployment down is a stronger economy. It's as simple as that. So if we were to grow at 3.5% in terms of GDP, unemployment would get back down to 4%. We heard the RBA talking about Nauru dropping to about 4 to 4.5%. So we need a stronger economy to get unemployment down, and that's when you get wages kicking up.
Stephen Koukoulas, always appreciate your time.
Thank you.